So welcome back to part 2 of chapter 13. So there are other things that happen with tangible assets that we need to talk about. Sometimes we do things to tangible assets that we already own, and the question comes up, do we have to capitalize those things, put them on the balance sheet as assets, or do we just expense them? And there's actually a fairly simple rule that GAAP propounds to help you make that decision. So if I do something that lengthens the useful life of an asset, then I want to capitalize it. Or if I do something that makes it more useful, in other words, makes it more likely to generate revenue in one way or another, then that should be capitalized. So let's talk about some examples there. Let's say we're dealing with a truck. If I buy a new transmission or overhaul the engine in my truck, then presumably that may add to its useful life. So let's say I had a truck that I expected to last for 5 years, and I did an engine overhaul at the end of 4 years, and now my expectation is that it will last 7 years. The cost of the engine overhaul will be capitalized and depreciated over the remaining useful life. And the remaining useful life, or the extended useful life. So the useful life at year 4 we think it's going to last to year 7. So we're going to take that engine overhaul, capitalize it as an asset, and depreciate it over the last 3 years. So year 4, 5, 6, and maybe it's 4 years, over the last 4 years that we expect it to last. If we're putting new tires on the truck, that's not extending its useful life. So those become an expense. Or if we tune it up or we change the oil, or those kinds of things are expenses. They don't extend the life of the asset. They merely maintain the asset. So those become operating expenses when they are incurred. So if it's going to extend the life, we capitalize it. Also, if we add a component, so we take let's say a pickup truck, and we add a dump body to the back of the pickup truck. So now we can use it as a dump truck, not just a pickup truck. Presumably that's going to increase its utility and its ability to earn revenue. So therefore, if it increases the utility of the asset, we capitalize them. And those get cost allocated or depreciated over the remaining useful life. So if we did that in year 3 to our pickup truck that we expected to last 5 years, we'd allocate the cost of the dump body over the remaining life. So we did it at the beginning of year 3, we'd have all of year 3, 4, and 5. So we'd allocate the cost of the dump body over 3 years. So they don't get added into the cost of the truck, but they do get recorded as an asset, and they get the cost allocation is either over the new extended life or the remaining useful life. Now let's go back to this for just 1 second, because students get confused sometimes. So we put in a new engine, and we expect the vehicle now to last 7 years instead of 5. Do we change the depreciation on the base truck? No, we don't. We remain consistent. We don't change that. We take the new addition and allocate that cost or depreciate that over the new useful life, but the base truck is still depreciated over its original estimated life. Remember, these are estimates. They're probably going to be wrong, because estimates usually are. So we'll talk about what happens at the end of life in a little bit, because most likely at the end of the useful life of the vehicle, in this case, or the asset, we probably guessed wrong. Maybe it's going to last 6 years, maybe it's going to last 4 years. We estimated 5, and we're going to have to make we're going to have to deal with that at the end of the life. We don't deal with it during the life. We make the best estimate we can and go forward from there. So assets that last longer than 1 year, we have to deal with allocating the cost of that asset over some life. We match the cost of its asset with its useful life, so that's the matching principle. For tangible assets, or for methods of allocation, 3 methods: straight line, production method, or accelerated methods. 3 kinds of assets: tangible, intangible, and natural resources. So let's talk. We talked a bit about tangible assets. Let's talk about intangible assets. And this is a really confusing part of generally accepted accounting principles, and this varies from what the international accounting principles, IFRS, allows. But we're learning, we're in the US and we're learning GAAP principles, so we're going to stick with the GAAP principles here. Just know that international principles treat intangible assets slightly differently. But GAAP says if we buy an asset, an intangible asset from outside, so you developed a patent and I bought it from you, then the purchase price and anything necessary to prepare for use becomes the cost of the asset on my balance sheet. If instead I hired some engineers and developed that patent internally, then it doesn't show up on my balance sheet. I expense the engineers' salaries. I expense all the research and development. And the only thing that might show up on my balance sheet would be the actual filing costs for the patent. So 2 different treatments for the same thing. So when you're looking at a company, if they have intangible assets like patents or trademarks or copyrights on the books, that means they bought them outside of the company. They bought them from somewhere else. If a company creates its own intangible assets, they get expensed at the time they're being created, and they don't show up as an asset on the balance sheet. So if you were to look at Coca-Cola's balance sheet, you would not see their trademark on the balance sheet. Does the Coca-Cola trademark have value? Yes. Is it worth a lot of money? Yes. Does it show up on the balance sheet? No, because they created it internally. They didn't buy it from an outside entity. Same would go for the Coca-Cola formula. It's not anything that is on their balance sheet. So when you're looking at a Coca-Cola balance sheet, you have to add those things in, whatever your estimate of those values are, in order to get an idea of the asset value of Coca-Cola. If Coca-Cola goes out and buys Snapple, and Snapple's trademark has value, then Snapple's trademark will show up on Coca-Cola's balance sheet because it's there with the purchase price of the Snapple brand. So 2 different ways to account for things, and people get very confused about that. But as a now knowledgeable financial professional, you know when you look at a balance sheet, you've got to understand that some companies have assets that don't show up on their balance sheets. Intangible assets get amortized, so we match the cost of the intangible asset over its useful life. So a patent has a useful life, depends on the patent, but let's say it might be 14 years or 18 years. That patent we purchased and it has 18 years left on its life, we're just going to use a straight line method and allocate the cost of the patent over its useful life. Some intangible assets have indefinite useful life, sort of like land is a tangible asset. We don't know how long it's going to last. Trademarks fit into that. Trademarks last forever as long as you renew with the government, so that there's no timeline, they never run out. And goodwill, which arises when we buy another company and pay more than the asset value for the company, that has an indefinite useful life. So those two things don't get amortized. They are on the balance sheet and they stay there until such time as they might become, quote unquote, impaired. So if I pay for a trademark and then I do something to harm the brand, the trademark brand, then it may not be worth what I paid for it anymore. And that's called impairment. I have to write it down to its new value or to zero if I've completely destroyed the value. So to amortize intangible assets, it's the same as straight line depreciation for a tangible asset. Estimate the service life. It's usually set by a legal limit. So patents or franchise agreements have timelines, and so it's pretty easy to set the service life. You estimate residual value, and for intangible assets, it's usually zero because once the patent expires, it doesn't have value anymore. It's usually either zero. I guess there might be some circumstances where it might not be zero for certain things. And then do your straight line depreciation formula. So it's the cost minus residual value divided by useful life, service life. And that's going to be your allocation each year. So it's always straight line. We don't amortize things with indefinite useful life. Goodwill is the one we've already talked about, and it's impaired. So I already covered this slide a minute ago. So we'll skip over that. And go on to natural resources. So natural resources also have lives longer than 1 year, and they can be used up over time. And what we call that is depletion. Things like oil, natural gas, coal, gold, silver, anything that we pull out of the ground, iron ore, bauxite, are all natural resources, and accountants also consider timber to be a natural resource. Even though it is renewable, the length of time necessary for it to renew is beyond the scope of most financial statements. Depends on the kind of timber, but 25, 30, 35, 40 years. So when we cut down a tree, we think that we consider for accounting purposes that that's a depleted natural resource. So timber is considered like the other natural resources in terms of accounting purposes. So natural resources provided by nature, they're on the balance sheet as fixed or long-term assets, and we calculate depletion just like units of production. So you've already learned how to do this. Think about how the asset gets on the books of a natural resource company. Let's take an oil company. Oil company buys a mineral lease, let's say from the government in the Gulf of Mexico. So they buy it at an auction from the U.S. government, and they buy the right to explore for oil and exploit it if they find it. So the government, the U.S. government, auctions off pieces of the bottom, essentially. And as an oil company, I can go and bid on those pieces of the bottom. And assuming I win the bid, that cost of that bid becomes a long-term capital asset. Then I go out and explore for oil, and the cost of exploring for oil gets added to that cost of the asset. I don't expense it now because I'm out there looking for oil, and it becomes an asset. Let's say I find oil, and I build a well, I build a drilling platform to exploit the oil, to take it out of the ground. I also have my geologists estimate how many barrels of oil there might be in the ground. So let's assume that whole process of paying for the lease, exploring, and then building a production well costs $100 million. And the geologists estimate that there's 20 million barrels of oil in the ground under this well. So we estimate our resource, so it's like estimating useful life. We estimate our resource to be 20 million barrels. We paid a total of $100 million to get these assets. So I think that works out to $5 a barrel is my cost per barrel. And like we did the juice machine, if we year one take 1 million barrels out of the ground, we're going to record depletion of 1 million times $5 or $5 million of depletion year one, which will be a part of the cost of extracting the oil. Of course, there's also the production costs of extracting the oil and building the pipeline and all of that, and taking it to shore or taking it to shore in a ship, whatever we're doing. All those other costs get added as well. But my cost depletion is $5 million or $5 a barrel. So fairly simple. Same thing would be true, and you're going to have some depreciation problems at the end of the week here, at the end of this session. So you'll have some homework, I guess, to do a little bit of depletion and depreciation accounting. So 3 different kinds of assets. Depreciation is for tangible long-term assets. Amortization is for intangible long-term assets, and depletion is for natural resources. They all basically mean the same thing, allocating cost over the life of an asset. And there are 3 methods of depreciation: straight line, optional for tangible assets, required for amortization, activity-based or production method, option for tangible assets, required for depletion of natural resources, and accelerated methods, option only for depreciation of tangible assets. So we've figured out how to allocate the cost. What happens when we get rid of an asset? Well, there's 3 things we can do. We can sell them, we can retire them, or we can exchange them. So when you sell an asset, we will result in either a gain or a loss, because we're going to sell it for more than its book value or less than its book value. When we retire an asset, we're going to essentially take it out of service but not sell it. I always use the example of dooryards in Maine. There's lots of retired assets in some dooryards in Maine, things that no longer are useful, but we're not really sure we want to get rid of them, so we put them in the dooryard. Whether those are refrigerators or old cars or whatever, they get retired. They're no longer useful, but they might be someday, so we keep them. So that's a retirement. And sometimes we trade assets. So we take an asset and exchange it for some other asset. So those are the 3 ways that we dispose of long-term assets. There's another kind of depreciation that we haven't talked about too much, and that's MACRS, modified accelerated cost recovery system. Not a coat recovery system. Not sure why we've got that there, but I wonder if I can fix that while we're talking. I bet I can. Oh, look at that. I can fix that. And it should say it's not allowed for GAAP, so you'll never see MACRS on a financial statement. It is allowed for taxes. And sometimes it's even required for taxes. You don't have to learn what MACRS is because it changes all the time. If you're a tax accountant, you have to know what it is, but what MACRS is this year is probably not what MACRS will be next year. And in the current since about 2007, when we started to have some downturns in the economy, MACRS has allowed for very fast depreciation or accelerated depreciation, oftentimes faster than any of the GAAP methods. So therefore, companies take MACRS depreciation on their tax return, but they use some other method. Let's, for example purposes, say they use straight line on their financial statements. So now we've got two different income numbers. We're reporting less income to the government than we are to the stockholders. So two different income numbers because we're using two different accounting methods to account for the allocation of costs over time. What this ends up doing is allowing the firm to put off some of their tax payments. We looked at the very beginning of this chapter, I said, the total depreciation over the full life of the asset will be the same. It's just a matter of when you take it, earlier in its life or later in its life. In MACRS allows for fast deductions, so we're going to take that depreciation early in its life, in the life of an asset, which means that we pay less taxes initially. We'll pay those eventually, but we're deferring them, we're putting them off. Because of that, we end up with temporary differences between what we're paying in taxes and to the government and what we're reporting as income to our stockholders. And when that happens, we make an accounting entry to account for that, and that's called deferred taxes. I'm pretty sure that when you looked at Kirby, you probably didn't see deferred taxes, but I'm pretty sure they're there. So it shows up on the balance sheet usually as a liability. There are deferred tax assets as well, but mostly they're liabilities because generally we're reporting less income to the government than we're actually earning. So we have a deferred tax liability that shows up. So that's what that is. When you see deferred taxes on the balance sheet, and almost all companies have them, that's because we're reporting more income to our stockholders than we're reporting to the government. And we account for that difference with something called a deferred tax. So the tax expense that we show on our income statement and our balance sheet that we show to our stockholders is the tax that we would have paid if we had reported all the income that we're reporting to stockholders to the government. So we get essentially a free loan from the government, and as long as companies are growing and acquiring more and more assets, those deferred tax liabilities generally stay there for the life of the company. The company starts to shrink, those deferred tax liabilities will go away. But generally, if you're growing, you're constantly buying more and more assets, and therefore you're constantly reporting a higher level of depreciation to the government than you are to your stockholders. So what it is, it's an interest-free loan. Eventually, you have to pay the government, but better to pay them later than now, and that's what deferred taxes are. So that wraps up chapter 13. Once again, there'll be a short few questions after this to be answered, and then there will be an assignment that's due at the end of this week with some short depreciation problems for you to work on and then turn in. Thank you very much.